We'll talk about some of the advantages of platform discounting. So if you look at the corporate side of it, why corporates would be interested in it? So there's some juice for the vendor and there's some juice for the investor. So why should corporates look at it? The corporates should look at it because they are getting an opportunity to extend their payables. So let's say today you are doing your payments after 15 days or 30 days. Given the fact that you have an intermediary coming in and being able to service the payables for you on behalf of you and satisfying your vendors, you are able to extend your payables for a certain time period. So let's say you extend the payables from 15 days to 30 days or 30 days to 60 days depending upon what is it that you're looking to do with that money. So that is the benefit for the corporate. And which is where they are increasingly utilizing these facilities to be able to extend their payables. So extension of payables is one of the biggest benefits for the corporates. Instant funding in 24 to 48 hours. So basically, when you talk about the marketplace, so these marketplaces, they are facilitating the payment to happen within 24 to 48 hours. Why? Because everything is online. So today, right from onboarding the vendor to onboarding the investor to onboarding the corporate, everything happens online. I mean, just to give you an example, I mean, as of today, somebody sitting in US who wants to utilize his funds that are sitting in his NRO account in India for a vendor who is sitting in Telangana and for a corporate which is sitting in Delhi. So if you want to execute this transaction, you can do that at 2 a.m. at night. So technology is breaking all the barriers, all the constraints, all the restrictions that have been, plaguing this particular industry. Online paperwork, as I said, given that it's a technology-based thing, everything is happening online. Then again, there are cases where, when you talk to the corporates, they come back and say, we are already doing all this. What's anything new about it? So advanced MISs and dashboard is one of the biggest, value addition that these marketplaces are doing as of today, in terms of the fact that everything was happening, but you were not aware of whether it was working, not working, what kind of results were coming out of it, whether it was beneficial for the company, whether you should put in those time, effort, and money into, executing it or not. That is something that now you will come to know. And portal access to suppliers and investors. So essentially, you are basically providing that portal access to everyone. They can just log into the cloud-based platform, and they can start, accessing the facility. Coming to the dynamic discounting part of it. Now, so dynamic discounting is basically a twist, from a platform discounting model. So think of a scenario where the vendor raises an invoice on the corporate, gets the approval, and figures out a date as to when he will get paid from the corporate. Now, instead of going to a third-party investor, which is where there's some level of underwriting involved, some level of paperwork involved, you offer that same invoice to the corporate itself. So, let's say, for example, a vendor of Tata Steel, after getting the approval from Tata Steel, they themselves, become interested in purchasing this invoice. So now the benefit that was going to a third-party investor through platform discounting is basically getting accrued, or is being, the benefit of that goes to the corporate themselves. So they have the money lying in their treasury, or possibly invested in something that is giving them a yield anywhere between, let's say, 6% to 9%, depending upon what kind of financial instruments you're looking at. But when you look at such a product where you are able to make an early payment to your vendor, so basically when you're buying your own vendor's invoice, that basically translates into an early payment to your own vendor. So it comes at a zero risk to you. So you anyways don't have to do any credit underwriting. It is essentially that you are making the payment instead of a 60-day time period, you are making the payment after 2 days. So there, the corporates are able to utilize that treasury surplus to earn better yields out of the money that they have available with them. And the biggest benefit over there is that it is not a mandatory thing. So let's say you are running this session every week or every 15 days or every month, and you have, let's say, a demand coming in for 50 crores, for example. Now, based on the amount of surplus capital that you have and the minimum discounted rate that you are looking at or targeting, you can decide that, okay, you will just fund 20 crores out of it because you're not getting the yield that you expect out of the rest 30 crores. So there is no compulsion on you. You can just go ahead with those 20 crores. What the system will do is the system will just send a feed to your ERP, which is where the payment dates for the approved invoices will get changed from, let's say, 60 days to 2 days. And for the rejected ones, the payment date remains the same. So in your system, in your ERP, in your procure to pay technology tool, the only thing that will change over there is the amount and the date when you have to make the payment. So there is an immediate realization of the gain that you have from the transaction. So a lot of companies, what they're doing is they're using this dynamic discounting tools to be able to get better yields on your early payments that you're making to your own vendors. And believe me, these kind of yields are far, far bigger than what you get from your normal instruments. So just to sum it up, dynamic discounting is basically a method used by buyers to extend early payments to their suppliers ahead of their payment date in exchange of a discount on the invoice value. So basically the way it works is that you as a corporate, whenever your vendor raises an invoice to you, your system throws a notification to them and asks for a bid or a discount from them, and all of these get collected, which you can look at as an enterprise, and based on the listing of the bids, you can decide which ones you want to select, and accordingly you can go ahead and approve or reject the bids. So what are the advantages of dynamic discounting? First of all, that there's no credit underwriting. So in case of a platform discounting, you still would have to look at, the investors will still have to look at the credit underwriting piece because you are buying somebody else's invoices. So they will look at the financials of the vendor, they'll look at tons of things to be able to take a call. But here there's no credit underwriting. So there's typically, a zero risk case. The other thing that is beautiful about this kind of a model is that it is a flexible cash discounting model. So a lot of companies you see, I'm sure most of your companies would also be running a similar program where you have a manual flat cash discounting model. That okay, fine. A lot of people come back and tell me, okay, we already do it, so what is so new about it? So when you look at a flat cash discounting model, that cost, the amount or the figure that you give to your vendors, that okay, fine, I'll give you your money in 10 days on a 30-day invoice at a 2% discount. So that price or that costing is there in the vendor's mind. So if he is ready to give that much, he will come to you, otherwise he will not come to you. So it works, if you look at the two extremes, somebody wants to get the money at a lower discounting rate. So there is a possibility that you have 50 people who agree to give you a 2% cash discounting, but there might be a scenario where you have 150 people who would have gone ahead if the discounting rate was 1.5. On the other side, if let's say somebody has a very high requirement or a very, very urgent requirement to get the money back or get an early payment, he might offer you more than 2%. But given that there is a roof at 2%, he will never offer you more than 2%. So it works both the ways. And in this kind of a scenario, you are never required to actually disclose that discounting rate to the vendor. Every month on month, depending upon the kind of availability of liquidity that you have, you can decide on it. So let's say this month you have 5 crores as surplus which you want to deploy. And you can be very choosy about it that okay, fine, I'll not do anything below 2% a month. But let's say next month, for whatever reason, you have a 50 crore surplus that is available with you and you want to spread it out because this seems to be the safest bet for you. You can bring it down to as low as 12%. Where you will be able to deploy all the surplus capital that you have. So there isn't one single rate that goes into the market and people take that as a fixed thing. Even the vendors will want to take a chance and see if their bid gets approved month over month. So accordingly you can tune it. Convert account payables from cost center to profit center. So one of the good things that this product comes up with, or this model comes up with, is that it helps you to save the cost. So when you look at an early payment discount, what is it that you're doing at? I mean, you are basically bringing down your expense. You are taking a cut out of the expense that you were supposed to make, which the vendors had raised through an invoice and you had approved, but you eventually saved that money. So your profit increases, or the gains out of those transactions increase. Flexibility of payment on need basis. So one of the questions that I get from a lot of corporate is that vendors will come to know about it and they will bake in this cost in their business model or their costing of the raw material. But one of the good things about the dynamic discounting model is that it's a need-based product. So in our experience over the last 3-4 years, what we have seen is anywhere between 15 to 20% of your vendors at any point of time have a need to take an early payment. And these 15 to 20% of your vendors will change every time. So the same number of vendors or the same vendors will not bid every time. So this, let's say the vendor might have a requirement 4 times a year. For whatever reason, there might be some kind of a festival happening, some discount, some kind of seasonality depending upon the kind of business that they are in. So that will essentially decide whether they will go for an early payment or not, and that will also decide what kind of discounting rate that they will offer to the corporate. Another thing that I would like to mention over here is when you look at the invoice. So let's say for whatever reason the first time invoice gets rejected by the corporate because of different reasons. It can be the availability of capital was not there, or the discounting rate was low as compared to what the corporate was expecting. So it also gets picked up another time. So you can do a multiple rolling of the same invoice till the time it is actually paid by your company. So let's say for example the vendor might not have the requirement as of today, but might have a requirement 1 week later or 14 days later. But if the invoice time period is 90 days, he might be willing to do it the second time or the third time. So this is about dynamic discounting. So what we have basically covered from the 2 discounting models is, the first one basically revolves around how the corporates can extend their payables and be able to utilize that working capital for any other purpose where the the incentives are far more than obviously paying your vendor. Second one is the dynamic discounting, where we are talking about the corporates utilizing their treasury surplus and being able to earn as high as 16 to 18% on an annualized basis. And why this kind of a return? Because when you look at the invoices and when you look at the the number of days for which it is due, it is never a whole number. Sometimes it is like 27 days, 16 days, 31 days, 28 days, those kind of things. And when a vendor goes in for a discount, they never look at an annualized thing. For them, it is a cost to get back the money. So for a 100 rupee invoice, if they are paying 1.5 rupee, that is the cost to get back the 98.5 rupees that is left in that invoice.